The following is for information purposes only and should not be considered investment advice. All opinions and views expressed by the contributors to this podcast are in a personal capacity only. They do not represent the views of Progressive Equity Research or any other organisation mentioned in this podcast.
Hello there, and welcome to Talk Tech from Progressive with George O'Connor and myself, Ian Robertson, the podcast where we talk about the UK small and mid-cap listed tech market and try and bring some facts and understanding to bear. George, what have you been looking at and finding interesting of late?
Oh, hey there, Ian. Great to touch base and to hear your views. Ian, as you know, these are generally quiet times. This is the phony war period. We've got our FY trading updates, and then we're waiting for the publication of the results. However, there's still plenty of news going on in the tech sector. Last night, we had Equinix from the IAS side. We had Reddit from social media, a whole chunk coming through on professional services. On the app side, Monday.com earlier this week. Infrastructure services, a rash there from ASIA, Brekla, Cancom, CDW, Inside, and loads on the recruitment side as well. This morning, we had Gattaca from the UK. We've got Kelly later on today, but we've had Staffline open up. However, in terms of the sort of flow of news, I'm really interested in Relics today. They had their full year results. I'm sure you've looked at this one many times over the years, Ian.
I have to say I haven't really. It's always been a bit sort of media-y for me.
So that's a very good point because it lives in the media sector. Anyway, this has been a massive win for investors. So last year's TSR was up 50%. This year, up 13% in the general sort of context of things. Last year, tech generally was up 11%. This year to date, it's up 2%. So relatively, this is a super one. I totally hear you in terms of it's being too media-y. However, the growth in shareholder value on Relics is really around its shift to higher growth, higher margin analytics tools across its division. It's got a massive moat built on proprietary, very hard to replicate data. And then, of course, thirdly, it's also got this power in terms of the growth in data analytics. There is a certain irony today that the best part of the results was actually based on the exhibition side, where you go in and you meet people, because that's all about footfall rather than the strength in terms of the analytics. So if we look into the divisions, the scientific technical side, that was up 4% year on year. The risk side up 8%. The legal, that was up 7%. And exhibitions knocked the ball out of the court.
But that's a bounce back, and other exhibition companies around the market have been doing okay.
Absolutely. As the world starts to recover, people go back to work. And the first thing you do when you go back to work is, of course, go to a tech conference.
Yes, try and find a way of not being at work. Excellent.
The rub on the stock, given that superb outperformance, is the valuation. A little bit white knuckle here, 41 times PE. As you know, Ian, sector's sort of around 19. They give a bit of a div. Yield on this one is sort of 1.4 and a bit percent. Tech is about 2% at the moment. The print today was in line with expectations. The positive surprise, the one that's really driving this, is a massive share buyback. Away from that, I see Relics as a company using its domain expertise in scientific, in legal, in risk to start to deliver really interesting outcomes from their customers by using Gen AI. I put this in the AI rag bucket of stocks.
Does this have a US valuation?
So it's on the market. It's listed both here and in America. While your PE suggests it's got a US valuation, I really see that this ability to unlock earnings upside as being really interesting. I think they're sort of, box perfect in terms of their operational positioning, domain expertise, that moat built around all of this hard to get to data and then creating those customer outcomes. I think it's great to see the results today because it really sort of dovetails into AI usage patterns. Now, there's so much navel gazing and romanticizing about AI usage. Anyway, the guys at Anthropic this week published their maiden AI economic index. Now, that's based on real life usage of AI from their customer set. The headlines from that is that AI is used in software development and technical writing. 36% of occupations use AI in a quarter of their tasks. Only 4% use it across 75% of their tasks.
This is in actual real applications rather than we're trying in this area.
Absolutely. In terms of the workload, 57% of tasks are being augmented by AI. 43% are being automated by AI. So the message in terms of the data is that for now, AI is not replacing people. It's actually working with them in areas like validation, learning, task iteration. So I think very pleasing set of data. Also, to give RELX investors who possibly are looking at that white knuckle valuation thinking, where next, it'll give them cause for relief as well. Probably what's not so exciting from a data side, because we had the Recruitment and Employment Confederation report this week. As you know, they produced the vacancy index. More depressing news there. The index slipped from just under 43 to 41.5 times. Now, any score less than 50 tells us the recruiters are seeing a weakening rather than improving market. And of course, the sharpest fall was amongst those higher paid professionals and in the tech sector. That research pretty much dovetails into what we're picking up from our salary research, looking at what day rates are going out there, but also the latest PMI data as well. We remain at trough, is my conclusion. And what we're supposed to be doing is following Buffett, buying when everyone is fearful.
But do you feel like it's not going any lower, or is it?
So it's the great unknown right now. There's a quiet confidence by the companies, but what the companies have done for the past 2 years is basically re-engineered internally. So they're in far better position to generate profit and turn that profit into cash. They've slimmed down the cost bases, but Ian, you're going to say, George, that's only because they overhired in that COVID period. So they've dropped down now. As we look at the recruitment sector, really to because that tends to move lockstep in terms of the economy, they're not guiding down, but the numbers are still on a downward trend. As I said, we've got Kelly later on today. We had Randstad yesterday. And what we're getting from Randstad, which is one of the largest recruiters in the world, is we've got the sort of pockets of growth notion. So, better in America, better in Asia for some unknown reason. They're also seeing better in Spain. The problem where we are at the moment is that when it's uncertain, the market tends to veer to contractors rather than full-time staff. And the economics of contractors are poorer than full-timers. So you see pressure on gross margin, but it's telling you what people are doing. It would be nice if it was the other way around to give us more of a sort of a positive feeling. Now, that said, if we flip into, say, the IT professional services side, we had MTEC just last week. They produced, for me, their best ever print. And the CEO founder in there, Rory MacDonald, saying, MTEC, in great shape to benefit from new public sector digitization programs. So, what's that doing? It's telling us really about, great vertical market positioning can also help. How about you, Ian? What's your perspective on where we are in the tech universe?
Where are we in the tech universe? Well, I think everything picks up where it left off last year, really, on AI being the big driver. Granted, the big boys' results didn't provide that much excitement. The real excitement that I found came from Palantir. Of course, being the accountant, I found the excitement in the wrong place here. I mean, Palantir is this famous, if not infamous, AI software stroke services business from the US that does a huge amount of work for US agencies like the CIA, FBI.
Ian, they also do a chunk with the UK public sector, feeding back into sort of the MTEC commentary. That's a great market for them to be in.
It is a great market, and it's an interesting business because of what it does. It's not a traditional software and services business by any stretch of the imagination.
Agreed.
Anybody who worries about character faults of Elon Musk really ought to get to know Peter Thiel and Alex Karp. Peter Thiel being the ex-founder of PayPal and therefore mate of Elon Musk, who is the largest shareholder at Palantir, and Alex Karp, who is the CEO. He is, a level beyond, shall we say. Bonkers, I think, is another word. But frankly, this business was founded in 2003 with a fundamentally different view of how to do software and systems and services in what can be described as chaotic environments. Businesses and enterprises, institutions that don't have fixed ways of doing things or ways of doing things that fit with traditional software approaches. Its initial reaction from funders and from the markets was, "You're mad," which to a certain extent it probably still is that. But the idea has come through and it is showing good returns. It's showing good returns in terms of revenues. It's now several billion of revenues, but it's showing spectacular returns in terms of the share price. A year ago, it stood at $20. A couple of weeks ago, it was at $80. And after last week's results, the shares are now edging up towards $120.
I like them apples.
Like them apples. Those Q4 results, 36% growth in the US, guiding for 31% revenue growth in 2025. They describe themselves as eviscerating the consensus estimates, albeit consensus estimates they were guiding to.
Ian, don't spoil it for us.
Interestingly, though, their growth in Europe could best be described as diddly squat. It's low single-figure percent, but luckily, because these guys come from where they come from in terms of mentality, in terms of worldview, it's not a problem for the company, it's a problem for Europe. The interesting thing for me is that this business could be said to be living on share-based remuneration. And if you look at the business overall, it's not making anywhere near the 39% operating margins that they claim they are, because the adjusted income for operations is 1.13 billion, but the share-based remuneration is close on 700 million. So around about a third of this company's cost base is being funded by share-based remuneration, which is great when your shares are going from 20 to 80 to 120. But what happens when the bubble all bursts? And I don't know, is the honest answer, because at the moment it's standing on 70 times revenues for this year, which gives it a market cap of around about $270 billion. And whilst it's exciting, it's doing some fascinating stuff, you have to look at it and think, well, what it's been picking up in the last 3, 4, 5 years when it's been showing this spectacular growth has been low-hanging fruit. Low-hanging fruit from customers who clearly need it. The likes of the US CIA, the likes of the NHS, people who are in what can be described as in the midst of chaos, not the big companies which have had long-term established systems and processes and software in place that's all working fine, thank you very much. So if we look forward to where's this business going, well, it's going to get harder and harder and harder for it to add value for its customers, because its customers, when it starts to look beyond the US chaos market, shall we say, they become adults and people who've already got themselves sorted out. So yes, there are going to be piecemeal products that they can do, and they'll be able to add value. They're not going to be able to walk into Shell or BP or Exxon or GE and say, right, let us run riot across your systems in the way that they've been able to do in the NHS or the way they've been able to do at the CIA. They're not going to be able to do that. And even if they were, they wouldn't be able to add the kind of value that they've seen themselves able to add in recent years for their existing customers. So it's going to be sort of pull up your desk chairs, boys. At some point, this is going to go pop. But I don't think it's immediate, which is another one of those classic AI frustrations, I'm afraid.
Ian, I hear and agree with everything you're saying. All I would say is sort of mean revision tells us at some stage, the problem is that will, I hate to say, mushroom, given your comments on share-based payments, because that's tied into the remuneration of the guys and gals who are working in there. When they see that sort of start to disappear, then they will follow suit. However, I think their TAM is a lot larger. They haven't really internationalized. They've got some UK contract stuff, but as we've sort of, scanned the news from the tech sector, there's a lot of talk around the opportunities in defense, not just from the usual defense contractors, but for example, ASIA Athia's in infrastructure IT, so a version of Computer Center. They're selling into the Nordics, and they've got multiple drivers in there, which they flagged. So defense is going to be bigger as, for want of a better word, we rearm,
Yes.
we restock, but we're going to be spending more money in there.
So the news flow will continue to be positive, I'm afraid.
Yes, and remember, they are referenceable, which is a huge lever into these markets, particularly in terms of the Five Eyes community. So that will help them in no end. Clearly, provincially for the UK, you've got to be security cleared to sell into that market. But that's stuff that they would be working on anyway. And if not, they will just be poaching staff. My sort of hanging around street corner research suggests they do pay over the odds.
Well, they have been quite open about the fact that they are having to pay using share-based remuneration because they are the new kids on the block.
Yes.
They're not the safe bet for a 24, 25-year-old techie graduate who's looking for their first big step into a profitable future. And they've only got 4,000 staff at the moment. This is not a huge business.
Correct.
It's got $3 billion of revenues. Yes, there is a long way further to go, but it's just a question of how fast can you get there, and can you go fast enough to justify 70 times?
Absolutely. It was just an aside comment that you made. I'm really interested in the FTE, the dynamics of FTEs. And you said, they've only got 4,000 staff. We're both sitting here dreaming of a company which will have $1 trillion valuation, and there'll only be 2 staff in there. One will be the CFO. But anyway, can I stop you a minute?
You can.
Really interesting case in terms of the UK. A company called Ensilica. Now, you know the domain from old. What's your updated view?
My updated view. Well, this one's interesting. I have to say, you commented in one of your Substacks recently about our friends at Raspberry Pi coming in at the low end of the range for their guidance, which I thought was more than satisfactory. But then again, I'm a long time observer of the semiconductor industry, and you said it's cyclical. And I think, no, you just can't damn well forecast this industry. That's why we have these ranges. And to a certain extent, Ensilica is suffering from that. It is a semiconductor design services business, or that is what it has historically been, and it is attempting to transition towards being a full-on fabless semiconductor business, providing ASICs, which are specialist chips designed for specific purposes within specific customers. And beyond that, when we look at the sort of major world of semiconductors, the big players are doing ASSPs, which are standardized products. So even when it gets to its short-term goal, it's got further to go. So there's a great story for this to become a proper semiconductor player, but I'm not sure it's going to make it, and I'm not sure that's actually its fault. It's standing on around about sort of 2 times EV to sales. It's not really making profits. The recent H1 results saw some cuts to the forecasts, mainly around the whole cash side of things. They'd done a cash raise last year, they reorganized their debt, but because of good old semiconductor slippage and defers and movements around in schedules, it's going to have a tough old time with its current balance sheet. And effectively, it's ended up really having a strategy that's being dictated by the balance sheet. And so with a tight balance sheet, can it make it towards being a full-on semiconductor industry player, or is it just going to end up, as it sort of feels like it's slipping back towards now, being a month-to-month contractor? It's taking business that 18 months ago it might not really have wanted to take. And when I step back from it, I think, has this company screwed up? What's it done wrong? Where have the management gone? I don't think they have particularly gone wrong. It's just a semiconductor business. And it's come to the market, and it's come to AIM and got enough finance and backing on a what can be described as not a best case scenario, but perhaps a broker case scenario. And that's what's holding it back, because I don't see where you go from here if you're in this situation. How do you go to the market and say, hey, boys and girls, what we told you a few years ago hasn't come through, and hey, this is actually the way the semiconductor industry works? How can you go to investors and say that? How can you do that? I'm not sure you can, which is a damn shame, because it challenges the long-term future of this business. And perhaps if the brokers could stand up and say, hey, boys and girls, we got this wrong. Sorry, we didn't look into it. we didn't give you enough guidance. How about putting your hands in your pockets?
Ian, as you well know, no broker is going to blame themselves. They're going to blame the company. But at the same time, can I stop you? In my tiny brain, the workflow you're talking about is that NRE, the sort of, the non-recurring engineering stuff, that is supposed to lead to royalties. And are you saying that part of the equation is broken?
Nothing is broken in this.
Yeah.
It is just the case that when you are trying to put together a semiconductor product, you're doing it for a customer who is then going to put this chip into their own product, which may then go into another product, which may then go into another product, which then may all go through system implementation, which everything all the way along the line on the route to market has potential for slippage. And each of those links as well is another sort of blur in the visibility side of things. And then looking the other way, in terms of the manufacturing and the design process, there are a number of steps where you can get knocked back. Issues come up, changes to design requirements. The fab's not ready. Fab doesn't have capacity. There's a tweak that needs to be done there, tweak that needs to be done there. And every time you go back to the fab, it takes months for your respin to actually happen. And this becomes difficult because if you start to put months into your own timetable as the provider of the chip, those months knock on to other people's planning. So I might knock mine back 3 months. It might have absolutely no difference whatsoever to the time the product actually gets to the market, but it could actually have 6 months or it could have 9 months. And do you know? Probably not. It's a tricky business and it's not software. I have to say, although I'm not being disparaging about analysts who are covering it, because it is an unbelievably difficult market to cover, and you have to actually sort of put your hand up and say, I'm going to be wrong, and accept that you're going to be wrong. And I think the most interesting thing about this way forward for this business is that you might listen to your broker and say, well, this is what the market thinks. When actually you look at what's happened with the share price hardly reacts at all when it's had a muck up, slippage, big issue. So I think there is actually out there in small cap land, in VCT land, there is a fund management community that does understand tech and tech hardware and electronics and electricals probably a little bit better than the broking community does.
Oh my God, you've just broken a market model. Ian, how could you do such a thing?
I don't think I've broken a market model. I just think that you just have to accept that some sectors are going to take longer to cover, and it's not all turn the handle on the sausage machine.
Very good. On that bombshell, Ian, you've uncovered the secret sauce behind Palantir. You've just explained to us why we just can't get semis right. And you've broken the entire relationship between the sell side and buy side industry. Ian, you have left me exhausted. I need to go away into a corner and cry. Many, many thanks for all of your views.
Go and hug some ARRs.
Until the next one, thank you very much.
Good to talk. Cheers.
Brought to you by Progressive Equity.